Howdy, folks. Welcome to Liberty Call. Today is Thursday, January 25th, 2024. Hope you're having a fantastical day out there. Looks like all the major markets here domestically finished in the green. The NASDAQ was tickling with red territory most of the day. And with the GDP numbers came out just exceptionally good. So complete shock there. We'll cover that. And anyway, so like I said, welcome to Liberty Call. As you can see behind me, we're doing a little painting here. And, the light color was what we went with down here when we first moved in 7 years ago. And now we've decided to paint it the same colors upstairs. So this is the last room. So going to do a little bit right now and probably finish the rest of it after close of business tomorrow, because I got to take my desk apart to get to the wall. So anyways, you didn't come here to hear about my painting and chores around the house. You came to hear about what happened in the markets today. So if it is your first time watching Liberty Call, if you could do me a favor, if you give me some thumbs up, like, share, subscribes, follows, and press that notification bell. All right, let's go ahead and get over to the markets for today. Dow Jones was up 0.64%, 242 points, closed at 38,049. S&P 500 up 0.54%, closed at 4894. NASDAQ up 0.18%, closed at 15,510. VIX up 2.8 or 2.66 as of right now. It's at 1349. Canada was up 0.36. Brazil was up 0.2%, and Mexico up 1.53%. Over in Europe, Germany was up 0.1%, the UK up 0.03%, France up 0.11%, the Netherlands up 0.98%, Spain down 0.58%, Italy down 0.6%, Switzerland up 0.11%, and Portugal down 0.52%. Russian exchanges were both red again today. The MOEX down 0.15%, the RTSI down 0.42%. And our friends over in Asia, the Nikkei in Japan was up 0.08%, Australia up 0.48%, New Zealand up 0.21%. In China, the Shanghai was up 3.03%, the Shenzhen Component up 2% even, China A50 up 1.75%, DJ Shanghai up 2.67%, Hang Seng up 1.96%, and the Taiwan weighted up 0.71%. So, Asian markets were jumping today. And I think last week they were down by a bunch. So it's kind of just back and forth, back and forth. So anyway, so it looks like all in all, the economy hasn't fallen apart yet. Give it time, but we'll get there eventually. All right, let's go ahead and move over to the market recap. U.S. stocks rise as soft landing bets get a boost amid ongoing economic strength. As much as I would love a soft landing and not to have chaos and carnage in the financial markets and in the economy, life experience tells me that's just not going to happen. I've been doing this for over a decade and a half, and I've been paying attention to the economy and politics since I guess '92 when I graduated high school. I was, somewhat into politics. Didn't really pay a whole lot of attention to the economy when I was in the military, but from the time I got out in '97. I paid decent attention to the economy and markets. So, all right, let's go ahead and get into this. The S&P 500 extended its record-setting streak, poised for a fifth consecutive session of closing at all-time highs. Investors digested positive corporate earnings reports and were buoyed by stronger than expected economic growth in the fourth quarter, contributing to the optimism about a soft landing. Economic data revealed a 3.3% annualized growth in the U.S. GDP for Q4, surpassing economists' projections of about 2%. Despite deceleration from the previous quarter's 4.9%, the robust growth indicated a resilient economy. Core personal consumption expenditures prices, the Federal Reserve's preferred inflation gauge, remained at 2% for the second consecutive month, supporting the notion that inflation pressures are subsiding. The encouraging economic indicators prompted a decline in Treasury yields, with the 10-year yield dropping 4.5 basis points to 4.135%. Tech giant IBM led the surge in tech stocks, climbing 9% following Q4 results that exceeded analyst estimates. The company reported higher free cash flow, particularly highlighting the doubling of book of business around generative AI and Watson X. United Rentals saw a 12% surge to a new 52-week high after posting Q4 results that beat expectations and announcing plans to buy back $1.5 billion in stock in 2024 while raising its quarterly dividend. American Airlines Group also impressed on the earnings stage with better than expected quarterly results and an optimistic annual guidance driven by strong travel demand. In contrast, Tesla faced a bearish squeeze, plummeting over 12% after reporting weaker than expected Q4 results and delivering a disappointing conference call. Boeing shares dropped 6% following a decision by the U.S. aviation regulator not to allow the expansion of production for its 737 MAX jet after a mid-air breach incident. All right, so that's what's going on in the markets today. Everyone seems pretty happy right now. I'm not sure why, but all right, let's go ahead and move over to the fourth quarter GDP, the initial reading. So let's go ahead and read through this a little bit. I don't have a summary of this. It's pretty short. Real GDP increased at 3.3% annualized rate in Q4, easily beating the consensus expectation of 2%. The largest positive contribution to real GDP growth in the fourth quarter came from personal consumption, while every other major component of GDP was up as well. Personal consumption, business fixed investment, and home building combined rose at a 2.6% annualized rate in Q4. We refer to this as core GDP. The GDP price index increased at a 1.5 annual rate in Q4 and is up 2.6% from a year ago. Nominal GDP, real GDP plus inflation, rose at 4.8% annual rate in Q4 and is up 5.8% from a year ago. So what does this mean? It's pretty good news, much all around in the GDP report for the fourth quarter of 2023. But that doesn't mean the risk of a recession is over. Real GDP grew at 3.3% annual rate in Q4, well higher than the expected 2% and higher than the forecast from any economics group. Although personal consumption accounted for most of the growth, every major component of GDP expanded, and real GDP grew at 3.1% in 2023, on par with the 3.2% pace we had in 2019, the year before COVID. We like to focus on core GDP, which includes consumer spending, business fixed investment, and home building, while excluding government purchases, inventories, and international trade, all of which are very volatile from quarter to quarter. Core GDP increased at a healthy 2.6% rate in Q4 and was up 2.7% in 2023. Perhaps the best news was that inflation came in below expectations, with GDP prices up at a modest 1.5% annual rate in the fourth quarter. Good news for both the Federal Reserve and investors. GDP prices were up 2.6% in 2023, a big improvement versus the 6% increases from the prior 2 years. Does this mean the risk of recession is past? Hardly. The money supply declined in 2023, and that, in addition to the inverted yield curve, should eventually drag economic growth down in 2024. Meanwhile, the surge in government purchases in the past year should abate as the federal deficit is on an unsustainable course. In addition, businesses are unlikely to continue accumulating inventories at the fast pace of Q4. On top of that, consumer purchasing power is running into headwinds due to the depletion of COVID stimulus-related savings, as well as slow growth in workers' earnings, which, due to inflation, are barely above pre-COVID levels on an hourly basis. Nominal GDP, real GDP plus inflation grew at 5.8% in 23, a major slowdown from the 11.9% in 21 and the 7.1% in 22. We expect continued deceleration in 2024. All right, so that was First Trust's opinion on the GDP news. So certainly a lot higher than, Mr. Westbury and his team are usually fairly close, and for them to be that far off along with everybody else, a little surprising. So I would not be shocked if they're going to revise that number down a little bit. So, or it's just like he said in the commentary that so much of government purchases and everything else that at some point will start to slow down. Will bring those numbers back down. So, all right, let's move on to the next story. U.S. new home sales rebound in December as mortgage rates retreat. All right, sales of new U.S. single-family homes experienced a robust increase in December, driven by declining mortgage rates and a persistent shortage of previously owned houses on the market. The Commerce Department Census Bureau reported an 8% rebound in new home sales, reaching a seasonally adjusted annual rate of 664,000 units, with November sales pace revised higher to 615,000 units. Economists had anticipated a rise to 645,000 units. New home sales constituting approximately 15% of U.S. home sales serve as a leading indicator for the housing market. Sales on a year-on-year basis increased 4.4% in December, totaling 668,000 for the entire year, marking a 4.2% rise from 22. Regional variations were observed, with monthly sales climbing in the Northeast, Midwest, and South, but declining in the West. The 30-year fixed-rate mortgage, a significant influence on the housing market, has seen a notable decline from its late October peak of 7.79%, averaging 6.6% last week. The rate reached its lowest level since May and was down from 6.66% the previous week. Despite the encouraging sales data, the median new house price in December was $413,200, reflecting a 13.8% decrease from the previous year. Builders implemented price cuts to attract buyers, contributing to a decline in overall house prices. However, the housing supply remains tight, with existing home inventory still significantly below pre-pandemic levels. Most sales in December fell within the 200,000 to 749,000 price range, and the total new homes on the market increased by 452,000 by the end of December. At the current sales pace, it would take 8.2 months to clear the supply of houses on the market, a slight improvement from 8.8 months in November. All right, so looks like the housing market's getting a little better. No, not great, but frankly, I'd like to see people, buy an old house, fix it up, as opposed to, just buying new land out further and further. But hey, do what you want. All right, last up, this is more just food for thought. As elections loom, CBDCs are becoming hyper-politicized. And this is from Andrew Singer via Cointelegraph.com. All right. Central bank digital currencies, or CBDCs, are emerging as a politically charged issue in the United States, with former President Donald Trump declaring his opposition to a digital dollar, labeling it a, quote, dangerous threat to freedom, end quote. This marks a notable shift in the discourse surrounding CBDCs, which was previously confined to financial regulators, academics, and payment specialists. The debate has now taken on partisan overtones, with Florida Republican Governor Ron DeSantis preemptively banning CBDCs in his state, while the Democratic Biden administration has been exploring the possibility of a government-issued digital dollar. The heightened politicization of CBDCs in the U.S. is seen as unusual compared to other countries. Concerns about privacy are becoming a significant factor in the global discussions around CBDCs, but the issue has taken on a particularly political dimension in the U.S. The Trump administration portrayed CBDCs as a form of tyranny, reflecting broader concerns about government overreach. The debate is expected to resonate with Americans worried about rapid technology changes in the crypto and artificial intelligence spaces. Critics of CBDCs fear that government-issued digital currencies could be used for extensive surveillance of private transactions, resembling Big Brotherism. Opponents often highlight China's embrace of state-issued digital currency as evidence of potential privacy concerns. The politicalization of the CBDC debate may lead to the U.S. refraining from piloting a digital dollar, which could have repercussions beyond the country's borders. Some experts argue that a robust public debate is essential to navigate the complexities of CBDCs, while others express concerns that the discussion is based on misconceptions and may lead to the U.S. avoiding CBDC exploration altogether. The relationship between CBDCs and decentralized cryptocurrencies like Bitcoin is also under scrutiny. While some believe CBDC rejection could benefit cryptocurrencies, others suggest that both can coexist as complementary players in the global financial ecosystem. The outcome of this debate could influence the trajectory of CBDC development and adoption worldwide. I'm not a fan personally, simply because I don't want the government having any say about what I buy, how I spend my money, having where my money disappears after a while. Because those are just some of the scenarios that I've heard from folks out there that know a lot more about the subject than I do, and because in some cases they could say, "All right, here's $100. You have 90 days to spend it, or else it disappears." Well, that's not cool. I mean, It's my money. I mean, what I got to buy. I mean, yes, that'd be good for the economy from a buying perspective that, you have 90 days or 6 months to use up the money that gets deposited to you. But that just forces you to go out and, generate stimulus in the economy, as opposed to if you want to hoard your cash and, put it in a lockbox or whatever it might be. That just, to me, that's just, that's not liberty and freedom. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful evening, and I shall talk to you next time. Adios.